An important classification in the mutual fund space is passive versus active. And we've been talking about the difference between the two for years now, but in case you're new to mutual funds and you're wondering what I'm talking about, well, it's a very simple explanation for you. If you are investing in the largest companies in India, there is a classification by the Securities and Exchange Board of India for mutual funds called large cap funds. If you're giving your money to a fund manager and you're asking them to invest in a large cap fund for you, then they can choose from the 100 largest companies in India listed on the stock markets. And they have to put 80% of what you give them into these 100 stocks. They can pick and choose. They don't have to put in all 100. Now, if you don't want the fund manager to choose for you and you still want to invest in large caps, you can invest in a passive option. And that can be either the Nifty 50 index or the BSE Sensex, or in fact the BSE 100, or any one of several index options that are available to you. That latter is a passive investment option. But the thing is, over the years, the argument has changed from it being better to invest in passive on account of a cost angle to there being much more involved in the process of choosing passive. Joining me to talk about this is Vandana Trivedi, Head Institutional Business and Passives at Axis Mutual Fund. Vandana, thanks so much for taking the time, and I hope that I've set the context.
Yes, absolutely right. Pleasure is mine.
No, it's my pleasure entirely. Talk to me about what investors are looking for now. It used to be that cost aspect, but it's gotten much more than that. And the argument of large cap passive being significantly better than active is old. Now that is actually extending into the mid cap space as well.
Absolutely right, Alex. We began, and this is not just true for India, this is true for the global context as well. Passives found its way in the investment landscape as a cost-efficient way of participation in the markets, which is basically what we call as beta, which is just that you mirror the market returns. You want to participate in the market. You're not really looking to outperform the broad market. That's how passives made their entry into investors' portfolios, and that's how it made its entry in India as well. But maybe over the last 3 or 4 years, what we are noticing as fund houses, which are managing both active funds as well as passive funds, is that the investors' demand for passives has moved only from a cost-efficient investment option to looking for more niche investment ideas. So what you're seeing, and if I were to quote some numbers here, what you're seeing, say, in 2025, is that probably more money has come into what we call as sectoral index funds or thematic index funds. Essentially, you just took your audience through the kind of indices that you could look at. For example, you said, listen, if you want to invest in the large cap space, then you have the top 100 stocks. A passive fund would invest in all of those 100 stocks, which form the Nifty 100 index, for example, if you were to take that example. An active portfolio manager would choose a set of stocks from those top 100, and it's entirely their discretion. Whereas what's now happening in passive investing is we've just moved beyond what we call as broad-based market indices. So I would probably bunch up large cap like Nifty 100, Nifty 50, Nifty mid cap 150, all of them as broad-based market indices. Now the transition has now happened to sectoral market indices. So you see flows coming into, for instance, say defense as a sector, for instance, say metal and mining as a sector, and where the underlying portfolio just tracks those indices. There is no active selection of stocks, but we see investors asking for those options. There are smart beta options, and we could talk more about it.
Yeah.
Smart beta options like momentum, value, all of these categories within passives is seeing substantial investor interest.
So it's much beyond just having that large cap allocation, which usually forms the core of your portfolio. And if you were to talk about core and satellite now, you've listed options available for people to consider the satellite allocation as well. So is this selection of a bouquet of passive products now going to be able to generate alpha kind of for you in your portfolio?
Yeah, I'd kind of put it this way. See, the alpha generation, I believe, will come from active fund
Hmm.
management. I mean, there is no denying that there is merit in having professional fund managers look into your portfolios and see what portfolio selection, etc., should be. But what some of these sub themes within passives do is that they, out of your core portfolio of, say, a broad-based passive fund, you just like topping it up with the intention of seeking some alpha from a certain sector, from a certain index, instead of getting selective. So there are, these themes are all narrow, right? For example, you can use any sectoral theme. A sectoral theme is a narrow theme. Now within that, if you were to get further more nuanced in stock selection, you may or may not actually exploit the alpha. However, when you're not sure about it, you're happy to just go with that index, which represents that narrow theme, which we call as sectoral index funds or thematic index funds.
Mm.
So there is a tactical play there which investors want to exploit, and that's where these index funds come in.
Yeah, it's a fair point. You know, I do want to ask about some of these factors, and it comes into the ambit of smart beta. The worry,
Yes.
though, Vandana, is that people misunderstand that there are periods of outperformance and periods of significant underperformance for either the tactical allocations that you were talking about in terms of sectors. There can be periods where something does incredibly badly. How do you communicate that? Because ultimately, when you have a diversified portfolio, you are trying to invest when the chips are down, and you
Absolutely.
need to be able to hold when those chips are down, because eventually it will turn around.
Absolutely. So I think that's where, Alex, the importance of an advisor comes in.
Mm.
What we are able to offer is narrow themes if an investor wants to play those narrow themes. And like you rightly said, there are these options or there are these possibilities where certain themes completely do nothing for a long period of time if you're lucky, or usually they just take you through a huge drawdown. So it's not an easy journey. It's a kind of a gut churning journey if you get it wrong, I would think. And that's where advisors kind of make the cut, and you take their advice to see which is that satellite theme that you want to play, say this year, say play for the next 3 years. They also probably help you understand if the drawdown in a certain theme seems temporary, and therefore you could wait the drawdown
Mm.
through, or you actually need to do some correction to your portfolio and maybe get rid of that narrow theme and replace it with something else, etc. But from a manufacturer's standpoint, what we're trying to also do is we recognize that themes go through cycles, and the cycles may be really short and really sharp, which may bust the risk profile of many investors. So therefore, what we do is we offer certain solutions even within these narrow themes, wherein an investor doesn't really choose a theme. For example, I can tell you that many of us in the industry do offer the smart beta investing as a basket, wherein you have all the factors in. So what that does is that over longer periods of time, that combination of factors, wherein you would have all the factors in as part of the portfolio, would act better than at least say 3 of the 4 factors at any given point in time. Obviously, there is always one factor which is really outperforming. So there could be a value today.
Mm.
There may have been a momentum last year. There could be something else next year. So it's very difficult to time it, contextually, and you're pretty much always smart only in hindsight.
Mm.
However, if you have a multi-factor kind of an exposure, then what you're doing in this smart beta category is that you are present in all the 4 factors. And historical backtesting data has shown that these kind of multi-factor options end up performing better than at least 2 to 3 out of the 4 factors. You would not get the best performing factor as your return, but overall, on an average, you're doing better. And therefore, those are certain solutions that we are offering to investors for people that want to do this directly or without help of an advisor.
Mm. You know what? So what we've done over the course of this conversation, Vandana, is present our viewers with a sense of the varied options that are available in the space, not just that plain vanilla large cap index fund that most people associated with passive. It's also gold ETFs, it's smart beta, as you pointed out, in sectoral and thematic
Absolutely.
indexes as well. But thanks so much for taking the time. Pleasure speaking with you.
Thank you very much. Thank you. See you.
See you. All right. Well, that brings us to the end of this edition of Your Money Matters. Thanks so much for watching, and do stay tuned. This is NDTV Profit.